Yeah. We'll move on to our next subject, which is another 8% weightage subject from an exam standpoint. This has 6 chapters overall, and all 6 of them are dealing with the internal finance function of a company, a finance department of a company. Corporate finance majorly deals with the internal finance function, right? Not the investments world, the internal finance function of a company, where couple of major activities we can visualize as investing in projects, or first of all raising of capital. From which source, how much capital has to be raised? Should it be from loans? Should it be from some kind of equity investment? So raising of capital, and how much it is costing me for that capital, typically called as cost of capital, the second chapter in our case. Cost of capital is nothing but how much cost it is costing the company, because if I'm taking a loan, some interest has to be paid. If I'm looking at equity investment, some dividends have to be paid. So there is always a cost associated with the capital that is being raised. So understanding of cost of capital is one chapter. The moment I have raised the capital, or before I raise the capital itself, I need to know how much I have to raise. How much I have to raise comes out from what are my business plans, where all I have to invest, what all are the possible things I need to invest, and how much. So that is what is an area of capital budgeting. You budget out how much you require for the next year based on what all opportunities are available for you, what all are the beneficial opportunities for you, because you cannot invest everywhere. So you are visualizing something. Based on your visualizing, you are thinking that this will be a profitable investment. So because this is a profitable investment, how much I have to invest? So there are 4 projects which I want to invest next year. The first one requires 5 lakhs, the second one requires 25 lakhs, the third one requires 55 lakhs, fourth one requires some 1 crore. All these 4 I will invest in the next 1 year. So I require probably somewhere around 2 crores. That is what is the capital budgeting process and raising of the capital. The moment I raise it, there are some risks involved with raising through loans, right? Because some interest factor, there are some benefits, there are some disadvantages, which is what we talk about in the chapter called leverage. Leverage is going based on some fixed kind of cost. Interest is a kind of a fixed cost. Whether you generate a profit or not, you have to pay the interest. So that is one chapter called leverage. The fourth is how do you handle the equity investments, especially the dividends. So there is one chapter on understanding of the dividends. That's the fourth chapter. Then as an internal member of the finance department, how do you manage the working capital of the company? How do you manage? Again, we'll discuss it in depth. The working capital primarily constitutes of your debtors and creditors as well as your inventories. How do you manage? How much inventory I have to manage, or how much inventory should be there? What is the optimal inventory? Should I stock more or less? So those kind of things are dealt as a part of working capital management chapter. And the final chapter is on corporate governance. How should a company behave with respect to the shareholders? Because majority of the companies which are publicly listed, they have a huge shareholder base. And it's not mandatory that all shareholders understand the business. I might have bought the shares of Reliance, but I don't know which business is Reliance into. I'm a shareholder of the company, but I don't know which business is Reliance operating into. Right? Is it doing all the business ethically, or is there some kind of unethical business? Is there some kind of black business that is going on? I'm not sure. Though they will share the details, but I may not understand all the details. So the corporate governance is a chapter which focuses on what are the things the company should deal with, how the company needs to deal with the shareholders. It's a very mandatory manual to be followed. So these are the 6 various chapters in level 1 which are focused towards your corporate finance. So the first of them is capital budgeting, which is primarily budgeting how much you require. The first aspect, next year how much capital do I require? That comes from identifying what all opportunities are there, which of these opportunities are profitable, which of them you need to invest, and how much you need to invest. That is what is being covered by the capital budgeting. So whenever we use the word capital budgeting, it's not a normal budget. Normal budget is regular expenses and revenues. Next year, how much revenues I will get, how much expenses I am going to incur. That is my regular budget. Probably if a union government is going to present the budget for the next year, it's simply for the next year, what are the various sources of revenue which it is going to get money from, and what all expenses it is going to put. Whereas capital budgeting is especially for capital projects. Capital projects, always the word capital in a finance parlance is where the cash flows are for more than 1 year. So when I am investing in a capital project, it means I'll get the benefit out of it for many number of years. Like I expand to a new geography, I open a new branch, I am investing heavily today, but with an intention that that branch will give me profits in the next 20 years or 25 years. Right? Not just in the 1 year. I am introducing a new product. I am investing heavily to introduce to manufacture that product, but with an intention that it will give me returns not just in this 1 year, probably for more than 1 year. Then those kind of investments, I call them as capital investments. Wherever the returns are going to be, the benefits are going to be for more than 1 year, I look at them as capital investments. And they are very key for a company because one, they involve huge investments. So a small decision here and there will have a big impact on the profitability of the firm. So from that reason, they are like they either make or break the life of the company. One big wrong decision taken, probably it will have a very major impact. So the understanding of the capital budgeting process is very important. And on the same lines, whatever are the mechanisms that are used, again the mechanisms are nowhere different from your NPV and IRR kind of mechanisms. They have applications in almost all investments world. As I said, the NPVs, the IRRs, you'll use them even in your stock market investing, you'll use them in the bonds investing, you'll use it everywhere. The time value of money, NPV, IRR, these kind of fundamentals, they are used across. So the capital budgeting fundamentals which are being used, they are used across also. And as I said even in the previous chapter, the main intention of a firm is to maximize the shareholders' wealth. Right? The company has to work for the owners. Any company for that matter, it has to work for the owner, and shareholder is the mini owner of the company. So I mean, this is always a classic problem, employees versus owners. If the employee does not have a share of a company, he may think he wants to do something which he likes, but the owners and the shareholders want something to be done which is profitable to the company. Keep your interests aside, work something which will generate the profits for us. So there is always a mismatch between these two. But what should prevail at the end is the owners or the shareholders' interest, because they are the ones. It's as good as probably saying the director thinks he can direct a movie of his choice. but the producer is the one who is investing in that movie. Right? The director should always look at, is like an employee. He is receiving a fixed salary. Whereas the producer is the guy who is actually making or breaking the profits. So the entire work of the project or entire work of an organization should always target towards maximizing the benefits of the shareholders, which is nothing but benefit of the producer. Only then proper movies will come into picture. Now if I say I'll direct an art movie which will never benefit any kind of a producer, the producer will not come forward to invest in that kind of a project, because for him it's a non-profitable project. Right? That is also a project. A movie is directing a movie or producing an entire movie is one project. Now, there is a big investment that is going on into that project. On what basis someone is ready to invest 100 crore in that project? Based on the forecast that he will get 120 crores out of it. Right? Even if I pay 10 crores to this hero, 5 crores to that heroine, whatever, even if I pay this much, probably I may still make 120 crores out of it. That is, he is forecasting it. So, what is happening in this process? One, there is a thought process that I have to look at I have to look at a particular project. Some idea has been generated. Based on the idea, I am looking at the financial feasibility of that idea. This particular kind of a movie. How much should I invest now? How much that will be decided based on how much I am going to expect out of that movie. Right? That is what is deciding how much needs to be invested. Now from there I will see from where I should bring the money. That is how the linking actually happens for a project. So the steps wise, initially there is an idea generation part. What kind of investments I have to make. Then evaluate the ideas, looking out for what are the cash flows that can come in future. First month how much I will get, second month how much I will get, if I sell satellite rights how much I will get, if I sell it to someone else how much I will get. These are all the various sources of cash flows which the producer will be getting. Now if he feels, so these cash flows are coming at different points in time. So I need to find out the NPV of all those cash flows. Right? Based on some expected rate of return. Okay, in the movie I should get 15% rate of return. Expecting 15% as the rate of return, expecting the cash flows for the future. If the NPV turns positive, he is ready to invest in that project. If the NPV turns negative, he'll pull out of that project. Right? That's where these guys keep complaining. If the director actually increases the costs and all, it is impacting his overall profitability. In any business organization, the employee should always work in the interest of the shareholders, not in his own personal interest. That is where an organized business is different from an unorganized business. In an unorganized business like movies kind of a world, where probably the director thinks he is the king, he can do whatever he wants. Whereas the person who is actually investing in that is the producer, who is the owner of that movie. Whereas in a real corporate scenario, whatever decision the manager wants to take, even if he is the CEO of the company, it has to get the approval of the board of directors, who represent the shareholders of the company. And for lot of decisions of the company, the shareholders have to give their vote, whether they are accepting it or not accepting it. He might be the CEO who is the captain of the whole company. But the approval has to be taken from the shareholders or the owners of the company. That's an organized business way. So whenever we are talking of any investment, there is a discussion that happens on evaluating the ideas based on how much cash flows are going to be generated in future, and based on that there is a budget that is allocated. Okay, 10 crores for this, 5 crores for this. Now if I have 20 crores, okay, I'll put 10 crores here, 8 crores here, 2 crores here. 3 different projects I'll take up. Though there are 20 profitable projects, I cannot take all 20 because there will be some constraints. Either uh, there could be a capital constraint from my side, or there could be a resource constraint from my side. I am not working in a unlimited availability world, right? So that's where I am doing a allocation and prioritization and looking at the strategic plan. Probably I may have a very good business opportunity in a movie, but that movie requires some kind of underworld activities to be done, which is not a part of my strategic plan. So though it's a profitable one, I may not get into that kind of production at all, right? And finally, it is like monitoring and auditing your project. Like if at all there is some kind of a forecasting error, because remember, every financial investment is based on forecasting only. There is no there is no finance which is based on actuals. Whole world of, when I say based on actuals, I call it as accounting. But when I say finance, it's only on forecasting. There is no actuals for finance. Because when I say finance, it's all about investing. I have to invest today, but the benefits will come sometime in future. And in no case the benefit is assured, except putting my money in a bank deposit. There the bank is taking the risk on my behalf. Bank doesn't know whether it gets that returns or not. But you will safely get your 8%, 9% on your FD. But to get that 9%, bank has to generate 13% from somewhere. Only if it can generate 13%, it will give you 9%, and 4% it will use for all its salaries and all that stuff. Right? So, the monitoring, the whole world of forecasting. How did I forecast? What was the basis for my forecast? Did I go wrong? Are the actuals different from my forecasts? So that is what goes as a part of your monitoring and auditing process, so that you can take appropriate actions at different points in time. Now when it comes to the capital projects, it could be of replacement projects. Some machine is damaged. I have to replace that machine. Otherwise business cannot run. That is also a big investment, because investing in a machine or an equipment, the benefits will be for many number of years. So those are all capital projects. Any replacements or any new expansions, business expansion, new geographies, new products, they are all capital projects. And sometimes we even come across mandatory projects. Let's say I have to construct, I have taken up constructing this metro rail project, right? For which I have done a detailed analysis, found that the NPV for the project is good, so L&T has taken that project. But if it has to get that project, probably some mandatory projects must be done. Like some environment related stuff has to be put up. Pollution related stuff needs to be put up. Some safety related, you have to mandatorily put up. You have to mandatorily put up red lights, signals, kind of stuff, even in the nights, so that people are safe, because you are digging up the roads wherever possible. So you have to make sure that the proper protections are put up by putting those barricades, kind of stuff. Or that's also a big cost for the company. Or they'll say you have to lay the roads before you start this process. So road expansions have to happen before the metro rail work has to start in that particular place. It should not cause inconvenience. So in these kind of projects, sometimes you may not have much of a profitability at all. They become mandatory to be done. Or probably if I say I want to develop one big commercial township. The government may say, if I have to give you permission for this, you have to lay a 2-kilometer road. Or probably plant so many greeneries this side, that side, and you have to contribute to the pollution preventing activity. That may not be a profitable project for you. But if you don't accept that project, you will not get permission for this project. Those are what are classified as mandatory projects. They generate almost no revenue for you. They are costs only. But based on that, you will get some other high revenue, high profitable oriented projects. So a company has to really look at, it's like proof of concepts or pilot projects where you may have to incur a cost with an intention that you will get some revenues in future, right? Or sometimes there could be some other projects which are more of a pet projects of the senior management. Somehow I want to do this. We don't know whether it is profitable or not, but he is very much interested in that project. So those may be against those may or may not get the approval of the shareholders, but still the management wants to take up those kind of projects. It's like risky projects, right? I want to invest in Mongolia. We don't even know whether the investment in Mongolia may fetch profitable returns or not. But this guy is somehow, the senior manager is somehow very serious about investing in Mongolia. If it turns out profitable, probably he is praised like anything. If it does not, which means in some cases, based on the heavy risk the company is going to take, some projects I cannot analyze directly through the capital budgeting process, but still I would be taking up those kind of projects. So these all will fall as a part of capital budgeting projects, where a simple way to classify them is where the cash flows or benefits are for more than one financial year. And few things that we have to understand while evaluating any capital projects is, I have to consider, all these words are very important. Incremental, which is if I am going for replacing a machine, I am only bothered about the incremental benefit. If I had the old machine, what was the benefit I was getting? If I am replacing that with a new machine, what is the benefit I am getting? The difference in the benefit is what we call as an incremental benefit. Because let's say if the existing machine, a simple example I'll give. Let's say I am having a Xerox machine. If I am using an existing machine, let's say every month it is producing 5 lakh copies of Xerox. But I want to replace that machine and buy a new machine which will produce 20 lakhs Xeroxes per month. Assume that demand is there. People will come to me up to 20 lakhs. Let's make that basic assumption. So here I am losing my clients because my machine can produce only 5 lakhs copies per month. Whereas if I upgrade to 20 lakhs, so the incremental benefit which I am getting is that 15 lakhs. By replacing this machine with a new machine, the incremental benefit that I am getting is only 15 lakhs. So I have to always look at only the incremental benefit, not the overall benefit in a capital budgeting process. What do we mean by capital budgeting? As I said, is it worth investing in this project? And if it is worth, how much? These are the two decisions that will come out of the capital budgeting process, right? So incremental, after tax. Because any extra profit that comes to me, some part will go as a tax. That is not my benefit, right? If instead of 5 lakhs, now if I produce 20 lakhs, let's say one page, for simplicity purpose, let's assume one page is 1 rupee. So I will get 5 lakh rupees there.